Well, Fitch has cut its China growth forecast for 2014 to 7%, down from 7.5% in 2013. The ratings agency says economic rebalancing in China and tighter global monetary conditions are exacerbating the country's structural vulnerabilities. China's transition to a more consumer-led economy is also expected to affect global growth. Fitch says the latest round of US earnings reflect a slower growth global environment and lower consumer demand for China. Let's get a read on this. Chris Weston standing by at IG in Melbourne. Chris, I can see that this is something you've noticed this morning, what's going on with Fitch's outlook on China. Now, it's not a huge downgrade, 7.5% to 7%. What do you make of it?
Yes, it's certainly below the street, Kate. We saw Standard Chartered, who obviously have their fingers in a lot of the Asian markets yesterday, saying that they raised theirs from 7.2 to 7.4%. So I think 7% is below where the expectations are. Of course, in November we've got the third plenary meeting in China, and that's going to be a very key situation. We're going to see a lot of reforms coming through. There seems to be a talk on the street that we might see the actual PBOC and the authorities there cutting their own longer-term growth rates to about 7% as well. So I think China clearly needs to rebalance. What they've been doing over the last, I think, 5 or 6 months is looking to support their economy and attract capital inflows where they can. Whilst the Fed were looking to taper, or that was certainly consensus in September, and we saw other emerging markets getting absolutely smashed, huge capital outflows because of the perception of lower liquidity coming through. China actually attracted that liquidity because it was spurring on pro-growth measures, hence why we saw this 7.8% handle in the recent growth numbers there. But what we've seen over the last couple of days is very significant, I think. What they've been doing in terms of allowing money markets to increase and therefore drain the system of liquidity, and not taking part in their usual money market functions with the different repo operations that they conduct. And that's what's caused the Aussie and Kiwi and some of the Chinese markets to underperform in the last couple of days. So it's clear that I believe now that we have seen the peak in Chinese growth, and we will start probably seeing it taper off a little bit. I think the fourth quarter you're looking for about 7.7%, and in 2014 I believe that we'll probably see an average of around 7.5%. We're not going to see a collapse in Chinese growth. So I think 7%, just to answer your question, is probably low ball. It's below where the market sees this. But I think it's time that China does reform, and we'll probably hear more about that in November.
Chris, what do you think was the trigger, though, for Fitch? It mentioned some of the sluggish earnings reports in the United States, for example, Caterpillar, which is obviously closely linked to what's going on in China. But what do you think was the main trigger point?
Yeah, I think I only saw the headline, to be honest, Kate, but it said something about industrial profits as well. And they've actually downgraded their global growth forecast to 2.9%, which, if you recall, was probably, I think, exactly the same number that the IMF had got. And it's, the investment banks have been running with a consensus of 2.9% global growth for quite some time. But for me, as I say, what we're going to be seeing in China now is this rebalance to a more consumer-led economy, and that's something that they've been talking about for quite some time. They haven't enacted on that as things stand because of what we've been seeing in the US and the slow or the tapering that was expected to see through there. So there will be a time when they're going to have to look less reliance on investment-led growth and look for more consumer-led growth, and that will probably have to start being reenacted next year. But I think what we're seeing now is they're saying, right, the property market's still too hot. We're seeing huge hot money inflows in the last quarter. If you look at their FX reserves, big spikes up there. The banks attracted something $20 billion in capital. And these are the situations now that the PBOC and the authorities there are just saying, look, we've got to drain the system of liquidity. And of course, that's going to have negative implications on growth going forward.
Chris, I want to ask you about earnings results over in the States at the moment and what you're seeing going forward there now that we've got some of those key numbers out.
Well, the numbers are great, Celia. They're fantastic. We've seen 44% of companies coming out thus far. We've seen Amazon, Microsoft, I suppose ResMed to a degree. Aftermarket, those numbers have been all good. I think ResMed numbers were not particularly brilliant. But if you actually look at the numbers, 77% have beaten. The traditional number, which we see, is around 62 to 65%. Revenue growth or revenue beats have been okay, probably just a bit under at 53%. But I think what we're seeing here, look, Kate, is an inflection point, so to speak. Certainly the bulls will be pointing out that. If you look at the consensus earnings since January, they haven't changed. We've seen multiple expansion coming through on the price earnings, multiple expansion there. The consensus earnings for the market, the S&P, has been about $111 since January. But what we're seeing now is cyclical-led sales growth. I mean, if you look at the aggregate sales growth on the S&P, it's over 6%, and that's been led by oil and gas. It's being led by materials. We're actually seeing sales growth in the industrial space. This is not a financial story, which it was in Q2. This is now, we're seeing cyclical-led growth coming through in earnings, which is great from a sales perspective. So that's why I think the market's looking at this in a very positive light. It's not just stimulus. I think we're actually seeing genuine money being put to work because of the sales growth and earnings growth that we're seeing in the market there.
Okay, Chris, finally, we've got to get some opening calls for you. Doesn't look like we're going to shoot the lights out at the open at the moment.
No, I think it's one to, at least from an index perspective, that we sit on our hands on the open, and we're going to see a pretty flat day. I mean, BHP's ADR is pretty much bang unchanged. There's going to be quite a lot coming through in Japan. We've got CPI numbers coming through there. The market looks like it's going to open a little bit low because we are seeing the dollar under quite a lot of pressure at the moment. Dollar yen's a little bit lower from where we are. But yeah, I mean, everyone's going to be, I mean, there's probably people holding ResMed, which we know there's a lot of people at the moment because the stock's done very well. They have missed on the EPS line by a couple of cents. They've missed on the revenue line. They've missed on the net income line by about 5 million there. So gross margins are pretty good, but you're still in a stock which is priced to perfection at 20 times, and we saw that down 13% in the aftermarket in the US. So they expect to see that stock coming off relatively sharply when that opens. But otherwise, I mean, yeah, it's hard to pick a sector where we're going to see substantial gains or losses. To be honest, it's a pretty flat day, and let's see what happens when the Chinese money markets open a bit later on. That could be our cue for the back end of the day.
Okay, Chris Weston, IG, thank you so much.
Thanks, Kate.